So for my presentation, I decided to look into Sotheby's Incorporated, which is actually a rather large multinational corporation, but I'm going to focus on the fine art auction segment specifically. Now they do have segments in other luxury goods areas such as autos, diamonds, wines, and even financing, securing loans through high-value art. But as I said, I'm going to focus on fine art auctions. So before Sotheby's was this big corporation, it actually had really humble beginnings. It was a small sole proprietorship. It was actually a bookstore owned by Samuel Baker in London. And in 1744, he was asked to auction off over 400 rare and collectible books from an estate. It wasn't something that his bookstore normally did, but he decided to try it out and had so much success that he ended up offering that service. His prestige grew as he began to work with earls and dukes all around England. But in 1778, he passed away, and the business went to George Lee, his partner for 10 years at that point, and Lee's nephew, John Sotheby. And over the next several years, ownership and the name of the business changed often, but the one thing that was constant was that there was always a Sotheby there. It became sort of a family tradition for them, father to son and so on. Not too long after, they began actually auctioning off collectible items, aside from just literary works and rare books, and that became especially true after World War I. The majority of their auctions were actually things other than books. In 1955, they opened up a flagship location in New York City, and their real turning point came for them in 1964 when they purchased Park Burnett Galleries, who were the premier fine art authorities in New York at that time, and it really launched them into success in the fine art auction category. 1977 was their initial public offering. They were oversubscribed 26 times, but their value doubled within 18 months. A couple years later, though, they began having some financial problems, and in 1983, a man by the name of Alfred Tobin, who's actually a mall developer, bought Sotheby's and began to kind of work with them to help bring them back up into this glory that they had had before by reprivatizing them. It didn't last long, though. In 1988, they had another public offering, and it was for about 5.5 million shares at $18 per share. Now, like lots of other large corporations, Sotheby's not only has a management team who deals with strategies and more day-to-day operations, and big picture operations too, but they have a board of directors that keeps the management interests aligned with the interests of the shareholder and the corporation itself. So you see the board of directors has 12 people in it. We have Domenico de Sole, the chairman, the Duke of Devonshire, the deputy chairman. You see Thomas Smith, who goes by Tad Smith, is the president of the board as well as the CEO of the company, so he's on both sides there. Then the management, we also have the CFO, COO, the head of global business development and digital developing and marketing. Now, with a company this size, for so few people to be focusing on so many aspects, so many segments, can become a bit overwhelming. So the board of directors has different committees to handle different areas of the business. The one most pertinent to this class, of course, is the finance committee. So you can see who is on that committee. They're denoted with that gray dot next to their name, with the exception of Mr. Dennis Weibling, who's the chairman of the finance committee. The finance committee has access to all of Sotheby's personnel, their facilities, their records, everything, so they have all the information available to make a good informed decision. So their job is basically to review everything that management wants to do. So if management has a new strategy they want to implement or a direction they want to take some aspect of the business in, they'll bring it to the finance committee who goes through, they talk about it, they review it, and then in the end they put together a recommendation to the board of directors. One of the other committees the board of directors has assigned is the Executive Compensation Committee, whose job, as their name implies, is to come up with a fair and motivating compensation package for the executives. So you see there's a different one for the CEO and then the NEOs, the named executive officers. But the setup itself is fairly similar. So for each of these, there's a base salary, which doesn't change. It provides a reliable income for each of the officers. For the CEO, that base salary only accounts for about 19% of their estimated annual take-home pay. For the NEOs, it's about 33%. The rest of it, the 81% for the CEO and the 67% for the NEOs, are called at-risk pay. And that pay is determined based on not only the individual's performance, but how the company does as a whole. Now, the executive could get 0 of that, or they could get up to 200% of that. So it can be a really good motivational tool. That at-risk pay is divided into 2 categories. The first is the annual bonus. You'll see that's about 39% for the CEO and 33% for the NEO. And that annual bonus is based off of goals that are determined by the executive committee and that executive officer. So they sit down, they design goals for the individual as well as for the company, and then at the end of the year they'll evaluate how the person did. So 70% of that annual bonus comes from how the company performed, and then 30% is based on the individual, like on a performance report. As for what those exact financial goals are, Sotheby's doesn't actually release them. They're the only publicly traded art auction house on the New York Stock Exchange. So they don't want to give their competitors, Christie's in this case, an unfair advantage. Christie's is privately held, so they don't have to release that information, and they don't. So the other kind of at-risk pay is an equity incentive, and it's paid in stocks. So that's performance stock units for the CEO, and then a split of performance stock units and restricted stock units for the NEO. Those are there to provide long-term incentive. So they vest over 3 years, so it helps keep the management engaged for the long term. Here we have a breakdown of the 2017 executive compensation for the top 5 paid executives at Sotheby's. First, you'll notice the base salary column. Valentino Carlotti, the head of global business development, only had about $131,000 in his base salary, but he didn't start until October 2017, so that's why his is so low. And then the non-equity incentive plan compensation, that's the annual bonus that I talked about before. That very well may be why his is empty there as well. You'll notice that Michael Goss, the CFO, he has no annual bonus either. His contract specifies that his annual bonus is to be paid to him in stock rather than in cash like it is for the others. And you'll see lastly there's an other compensation category. That includes things like company payments of life insurance premiums, company contributions to retirement savings plans, and the company allocations of the company's deferred compensation plan. So investments and acquisitions is really an area of strength for Sotheby's. They're really good at reviewing their performance and kind of identifying any gaps that can be filled and then making a move to fill them. So in 2015, they invested in RM Auctions. They actually hold 25% of the shares, and RM Auctions is now known as RM Sotheby's. The carrying value at the end of the year 2017 is $36.4 million, and their equity earnings is $1.2 million, and this is their auto segment here. In 2016, they acquired Orion Analytical, which is a really renowned art authentication company, and also MyMoses Art Indices, which is a database of sales patterns across 8 different art collection categories, and it really helps them with forecasting sales and picking out trends. They also acquired Art Agency Partners, and that was meant to enhance their sales in the Impressionist and Modern and Contemporary art categories, which had been really an area of struggle for them for the last 2 years. But that was one of Art Agency Partners' specialties, so it was a really good acquisition on their part. And they were also able to add another revenue stream by keeping AAP's client advising service. And finally, in 2017, they purchased Viet, who's a relatively small company. They didn't even disclose the purchase price in their annual report. But they are an online fixed price marketplace. They specialize in vintage home decor and furniture. So I mentioned earlier, Sotheby's is traded on the New York Stock Exchange under the symbol BID. The closing sales price per share on August 3rd was $52.91. That was a decrease of 0.06% from the previous day. There were no bids or asks, but the 52-week average for those is $42.78 and $60.16. Analysts predict that the sales price for their per share is going to be about $65 in 1 year. with 4 out of 6 rating it as a buy, 1 out of 6 rating it as a strong buy, and the last rating it as a hold. You'll see a graph of the historic trend of stock prices over the last year, and you'll notice that there's dips and rises, and then it dips and rises, but you'll notice that the overall trend is upwards. Currently, they don't have any preferred stock outstanding, but they do have 50 million authorized, and they have a little over 50 million shares of 0.01 par value Class A shares of common stock outstanding. Their largest stockholder is Taikang Insurance Group. They hold over 7 million shares. And from this, we can actually get their price to earnings ratio by dividing their stock price, which we said earlier was $52.91 per share, by their earnings per share, which for the first quarter was $2.30. And we get a price to earnings ratio of 23. Going forward, analysts think this is going to drop to 17.12, and they predict higher earnings in the future. We can see that their beta is 1.97, which indicates it's more volatile than average when it comes to the returns relative to the market overall. And this is not really surprising given the volatile nature of the art market. Unfortunately, since they don't have any publicly traded competitors, we can't compare it to the stock of another company. They currently have 3 bonds issued. You can see their maturity dates there. The earliest maturity is 2022, and then the other 2 mature in 2025. Only one of them is rated, and it was given a BB- by Standard & Poor, which puts it in the junk bond category. It's not surprising that Standard & Poor would rate this as a high risk. There's potentials for high returns, but it also kind of does indicate that it's iffy. I mean, again, the art market is very volatile, so it's not a sure thing. But this junk bond rating could also kind of be because of Sotheby's reliance on their consigners, since the auction is held not really out of Sotheby's own inventory, but people coming in and Sotheby's auctioning it for them, taking a commission. So it is really reliant on people wanting to work with them rather than having a high inventory. So when we look at capital structure, we see that the total equity on their balance sheet is just about $617 million, and about 709,000 of that is common stock versus about 555 million of treasury stock. And there's been a big push to repurchase shares, which we'll discuss in a little bit. So looking at the liabilities, they have a credit line through an international syndicate of lenders according to their annual report. And in October, they voluntarily reduced their credit limit by $235 million to help eliminate fees they were incurring for unused borrowing capacity. So now their limit is $1.1 billion. $300 million of that is allocated to their agency segment, which is their art auction side. Another $800 million is allocated to financing. So according to Yahoo Finance, their debt-to-equity ratio for the first quarter of 2018 was 1.24. So for every $1 in equity, they had $1.24 in debt. If we look back at that number throughout history, at the end of 2017, that number was 1.37. We look at the end of 2016, it was 0.89. The end of 2015 was 0.44. And a big part of this change those last couple of years is probably their big push for stock repurchases. So that would reduce their equity but leave their debt the same. So I mentioned earlier the stock repurchases. So they've actually done that in lieu of paying dividends. So they haven't paid any dividends since November 27, 2015. But when they were, that dividend was about 10 cents per share paid quarterly from about 2014 on. Prior to 2014, the number kind of changed between 6 cents per share to 15 cents per share. So 10 cents is kind of really right about average to what they were doing. So the share repurchases, initially they were authorized to repurchase 125 million in shares. But you can see starting on August 6, 2015, that authorization was increased by another 125 million and continued to be increased all the way through February 2018. As of December 31st, 2017, they had repurchased 17.8 million shares for $529.3 million, and that averaged about $29.72 per share. So looking forward, Sotheby's talked primarily about two big strategies on their earnings call, which happened on May 3rd. The first strategy that they addressed was really targeting private sales, which up to this point hadn't really been a strong point for them. They had more focused on their auctions and commissions. So they've since hired new staff and new leadership specifically focusing on private sales, and it's really paid off for them. Their private sales have gone up 70% from the first quarter in 2017 and now sit at about $246.6 million of their revenue. The other big push that they're making is for the integration of technology. They've started doing online-only auctions with about 49% of their clients attending. They've begun producing web series with different art documentaries that are really popular on their website. They actually won a Webby for it and were nominated for 2 others. And their online marketplace, Via, is another way people can deal with them online. And they have a really active social media page with over 1.5 million followers. So they've really embraced kind of this technology that's obviously so prevalent in modern society. And when you think about it, a lot's really changed in the last 274 years since they've been open, and Sotheby's has really kept changing right along with it. Their creativity and their adaptability are surely going to help them stick around for a lot longer to come. It's going to be really interesting to see how they keep evolving.